But what is the other reason, which is more strong, is that when government fail to manage its currency or its money supplying policies or like that, right? Then better option is to peg with the stable currency. When you cannot run your central banks, when you don't have some, you can say, qualified persons, for example, in many African countries, the education, especially financial education, is extremely weak. And if you need to hire a person for their central bank, then they need to hire from the outside world, from the developed countries or from developing countries, because they are underdeveloped countries. So most of the time, because they are foreigners, so they are not given the full information. So they manage or they decide what is the best possible information available to them, because there are some government secrets and all this stuff as well, and it can be used as a weapon, economic or financial weapon as well. So that's why over there, due to this huge secrecy and the unavailability of highest, you can say that educated people, they cannot run, or they failed to run their financial system over there. So that's why they go for pegging. So when they peg, what happened? Governments peg their value to that stable currency such as dollar, because if you see the history, dollar is the most stable currency, because because of that, because it forces the value of the currency to be stable as well. So you heard, I think, back in 2005 through 2000, I think 8, there is huge crisis in Zimbabwe dollar, and right now it is now right now the situation of Venezuela is also like that. The price of one burger is, for example, 9,000 Venezuelan peso or Venezuelan dollar, whatsoever is the currency over there. Right? It's huge. I hope they try to cope up with that, because I saw one documentary. It's a little bit old, but over there I see that people are just struggling for their local currencies. They want to deal with the dollar, not trusting on their local currency, because it's depreciating on daily basis. So how the pegging works? So when you peg with the dollar, because it's the most stable currency, first this forces their currency exchange rate system with the dollar to be fixed. Second, the currency will move against non-dollar currencies by the same degree as US dollar. What does it mean? It means if dollar appreciate, then your currency, for example, is Mexico, also increase. Whether you make the policies to export more, it should be decreased. But since the dollar value increase, your policy is going to a failure. Why? Because you pegged, and it's not in your control. If dollar increased and your policy is to increase the export by decreasing the value of peso, and it will not happen. So why dollar is pegged? Because it is the most stable currency among other currencies. Advantages is that it may attract foreign investments. Why? Because when the foreign governments or foreign companies, they want to invest, they see the stability, because they need to plan, right? And they plan their profits as well, for 1 year profit, 2 year profit. So that's why they come to your country. Otherwise, if your currency is unstable over there, then what happen? Their planning is disrupted and they avoid to invest in your country. So that's why they always talk about political instability. Why? Because political instability directly affect the stock market and the forex market, currency market. Disadvantage of peg currency is that weak economic and political condition can cause firms and investors to question whether the peg to be broken or not. Your current political condition is weak, economic condition is weak, but it's like that you think that your country is comparable to the most developed country. The rule of comparison is that you need to compare apple to apple. Apple cannot be compared with the pear, apricot, or banana, right? So this causes the condition because you are giving your hand and you are at the mercy of other governments' monetary policy, right? And due to that, your country may be worsen economically. Also politically as well, because when people they are facing some kind of economic problems, they will go for protest and they will talk about change in governments. It's like that. You look at the condition of right now, what's going on in France. Yellow vest movement is over there, in Venezuela as well, in Cambodia, I think, not Cambodia, in in Cuba, and in some other countries. Colombia, yes, Colombia as well. If foreign investors fear that a peg may be broken, they may quickly sell their investments in that country and convert the proceed into their home currency. Why? Because when there is instability over there, then the price of or the currency exchange rate decrease considerably. So they just wrap their business up and then just go back to their countries. So this will further put pressure on your currency to decrease, and your country will be worsen due to that move as well. So even the local residents may consider selling their local investment, but that is also in their home currency, not in dollar. So this will also increase the supply of your home currency. Plus the foreign businessmen, they convert their or they wrap up their business, they also supply a great amount of home currency. So at the end, the exchange rate of your home currency decreased considerably, right? So you are again at worse disadvantage using pegged exchange rate system. So countries have difficulty maintaining the peg because when they are experiencing major political or economic problems, the peg is not according to their expectation. Why? Because it is at the mercy of the currency movement of that which is you pegged with that. For example, if dollar, for example, if right now there is currency is unstable due to this Trump and Biden, election, and you are going through a major change, and what happened? The currency is going up, going down, going up, going down, and it will unnecessarily placing too much pressure on your political movement as well. While a country with a stable exchange rate can attract foreign investment, so thus a pegged exchange rate system can ultimately create more instability in that country. Like I told you, you cannot compare small underdeveloped country with a developed country, because developed country has its own political system, its own economic conditions, its own benefit for local people, right? So which may be not coincide with your political or economic condition. If that happen, then your economy further unstable and worsen with respect to politically and economically. So examples, this is European Snake Agreement, which lasts 1972 to 1979, and then European Monetary System. They pegged with the dollar. Mexican pegged system ended in 1994. And China's pegged exchange rate system ended in 2005. Then Venezuela ended in 2010. So when you go for pegging, then there is a currency board that should be established from which currency that would be more, good for us, or they're going to be index that we will be following. So a system of pegging the value of the local currency to some other specified currency, the board must maintain currency reserve for all the currencies that it has printed. So if your currency is backed by dollar, then you must purchase dollar and save it with your bank so that you can issue your pesos against these pool of currencies. If the reserve go down, then what happen? Pesos start depreciating. If reserves going up, pesos start appreciating. Right? Interest rates of pegged currencies, interest rate will move in tandem with the interest rate of currency to which it is tied. If interest rate of the dollar is 1%, and when you convert it into your peso, it is like 5%. And if interest rate of dollar increase to 2%, then your interest rate will automatically jump up with 10%. Because this increase is 100%, your also interest will be increased by 100%. It means you have no control over your own interest rates. And then exchange rate risk of a pegged currency. So currency that is pegged to another cannot be pegged against all the currencies. You cannot say that our currency is pegged with dollar and also it will be pegged with Australian dollar, Canadian dollar, euro, and all those stuff. You cannot say that. If you peg with dollar, you will stick with the dollar. So exchange rate risk with other currency will remain the same, and also it will be but it will be minimized with the dollar because your currency is more pegged with the dollar, but it will remain exposing to exchange rate risk with the euro, pound, yen, and like that. But if the relationship between dollar and pound disturb, it will also affect your exchange rate as well. So Beck's exchange rate system, Exhibit 6.2 tells you that Bahamas, their currency was Bahamas dollar, Barbados dollar, Bermuda dollar, Hong Kong dollar. They are pegged to US dollar. Similarly, Levita Lat, they are pegged with the euro. Saudi Arabia Real is pegged with the dollar. Tunisia with dinar. So they are going towards a portfolio, and major tilt is towards euro because its weight is 67%. Dirham and Bolivar, which is the currency of Venezuela, was backed with 2000 with US dollar, and it ended in 2010. So we just covered the exchange rate system: fixed, floating, managed, and then pegging. Then what is dollarization?